So, today we're going to talk about how to reduce estate taxes without using any gift exemptions. A lot of high net worth people, and even their CPAs, estate planning attorneys, and financial advisors, they think that once a person has used up their unified tax credits or gifting credits, that there aren't any other ways to transfer their wealth to the next generation during their lifetime without incurring gift taxes, which is actually not true. So, our proprietary G2 plan accomplishes two things. One, it allows the client to keep their family owned businesses and their other key assets in the family for the next generation. And two, it drastically minimizes their estate tax liability. So, let's take a look at a case study of one of our clients. So, this particular client had $10 million in cash and marketable securities. They own two businesses, each business worth $20 million, so a total of $40 million in business valuation. Their primary residence was worth $5 million, and their vacation home was worth $3.5 million. So their total taxable estate was $58.5 million. Now, based on their current taxable estate, at a 40% estate tax rate, Generation 2, meaning their adult kids, would have a $23.4 million estate tax liability. And by the way, this didn't even take into consideration any growth factors on their estate. Realistically, their businesses, their real estate holdings, and their investments would most likely grow over time. So our leverage G2 plan saved them $14.4 million in estate taxes, which is not a bad savings, right? So let's take a look at how we did it. Step one was to establish a beat it. So a beat it is a beneficiary defective inheritors trust, which is an irrevocable trust, which allows the client to be both a beneficiary of the trust and control the investments inside the trust. Now, a couple things about the beat it. It cannot be established by the client or a current or future beneficiary of the beat it. For example, the person establishing the beat it could be a parent, a sibling, or a business partner, assuming that none of those individuals are beneficiaries of the beat it. But it could not be, say, the children of the client, assuming that these children are beneficiaries of the beat it. So the client would not make gifts to the beat it. They would only sell assets to the beat it. So in the case of our client here, we had them sell $40 million of non-managing member interests of the two businesses to the beat it in exchange for a promissory note. These non-managing member interests were discounted 30% down to $28 million. Okay, so step two was to establish an irrevocable life insurance trust, otherwise known as an ILIT. And so an ILIT was established outside of Generation 2's taxable estate, and a life insurance policy was placed on Generation 2. The total cumulative premium contribution was equal to the amount of the assets that Generation 1 sold to the beat it, in this example, $40 million. This cumulative $40 million of life insurance premium was financed by a third-party lender. This component of funding the life insurance premium is known as premium financing. Now, the policy is a non-MEC with the explicit intent of remaining in force for the duration of Generation 2's lifetime. And it will accumulate cash value for the benefit of Generation 2 and could possibly generate a retirement income stream for Generation 2. And obviously, the policy will generate a death benefit that will eventually pay off the intergenerational loan at the end of Generation 2's life. Now, and possibly leave a benefit for Generation 3 as well. That's Generation 1's grandchildren. Okay, so step three was to establish the split dollar loan between Generation 1 and the ILIT. So to accomplish this, we took the $40 million loan from the bank and capitalized a new LLC with the $40 million premium financed loan funds. And then the LLC made a loan to Generation 2's ILIT in exchange for a split dollar note with a long maturity date. In other words, the repayment obligations of the note were deferred until the death of Generation 2. Now, this $40 million intergenerational loan was between Generation 1's LLC and Generation 2's ILIT. And the primary asset of the LLC was the split dollar note. Okay, so step four was to have the client sell the LLC to the Beat It. Now remember, this LLC owns the split dollar note. So now the Beat It owns the LLC, which includes the split dollar note repayment obligation. So the sale was executed in exchange for a 60% discounted note back to Generation 1, discounted from $40 million dollars down to $16 million. dollars. Now, the value of the LLC was formally appraised based on the underlying assets inside the LLC, and in this case, the primary asset of the LLC was the split dollar note. So the LLC was valued at a substantial discount in accordance with the value of the discounted split dollar note. Again, in this case, $16 million. dollars. So, in order to validate the discount on the intergenerational loans, there needs to be a verifiable plan in place to repay those intergenerational loans. And this is where the life insurance policy comes into play. So, based on the plan document, upon the death of Generation 2, the life insurance death benefit would pay out to Generation 2's ILIT. The ILIT would then repay the $40 million split dollar note, plus accrued interest, to the Beat It, and the Beat It would repay the $44 million in outstanding notes back to Generation 1's estate. Again, that's the 30% discounted note from selling the non managing member units of their business to the Beat It, which was discounted from $40 million down to $28 million, plus the 60% discounted note from selling the Split Dollar LLC to the Beat It, which was discounted from $40 million down to $16 million. Right? Add those up, and that's the total of $44 million paid back from the Beat It to Generation 1's estate. And then $40 million of that $44 million repayment is used to pay back the premium finance loan. But remember, the death benefit was $80 million. So there's still $36 million left over in Generation 2's ILIT for the benefit of Generation 3. Again, that is Generation 1's grandchildren. So here's what the client's balance sheet looked like before implementing our Leverage G2 plan. And here's what it looked like after implementing our plan. Now, obviously, they still had the $10 million of marketable securities, but in this example, the $40 million sale of the two businesses to the Beat It was discounted 30% to a value of only $28 million. Again, that's the $40 million sale minus the 30% discount, which equals the discounted valuation of $28 million. The premium finance life insurance loan showed a $40 million liability on the balance sheet, reducing the taxable value of his estate by $40 million. Now, the client also sold the LLC to the Beat It. And remember, the LLC held the split dollar note. So the sale of the LLC to the Beat It for a 60% discounted note resulted in a $16 million asset on the balance sheet. Again, this was the $40 million premium finance life insurance loan that capitalized the LLC, discounted 60%, equaling a $16 million discounted note, which was an asset on the balance sheet. The primary residence was still valued at $5 million, and the vacation house was still valued at $3.5 million. So by implementing our Leverage G2 plan, that reduced the client's taxable estate from $58.5 million down to only $22.5 million. After the 40% in estate taxes, this resulted in only $9 million of estate taxes due instead of $23.4 million, which ultimately resulted in an estate tax savings of $14.4 million. So, in summary, by implementing our Leverage G2 plan, the client was able to keep the ownership and control of their businesses inside the family for the benefit of Generation 2. It also allowed Generation 1 to maintain control over their assets and not use any of their unified tax credits. In other words, their gifting exemptions. But the big benefit is that we were able to save the client $14.4 million in estate taxes. And by the way, the attorney that we used to draft our Leverage G2 plan documents is actually the former director of the Gift and Estate Tax Division of the IRS. And he was the director during the year of 2003 when these tax code regulations were updated. So, one of the most frequently asked questions we get is there any case law that supports this type of structure? The most recent notable case law examples of this type of planning are the Morissette 2 case and the Levine case. In the Morissette 2 case, on May 13th, 2021, the IRS disputed the 77% discount that was appraised. Morissette basically attempted to discount $30 million dollars down to only $7 million. dollars. The reason the court ruled against Morissette was due to the short holding period of the life insurance policy. Basically, the IRS found emails that uncovered a premeditated plan to surrender the life insurance policies after only 4 years, just outside an audit statute of limitations. This was considered to be an abuse of the life insurance component, simply to get the discounted receivable validated in the year of valuation, with no true intent of paying the note back. It was determined that Morissette's intent was to discount the estate value, wait for the statute of limitations period to end, and then collapse the plan, including the life insurance policy, making all transactions unauditable from that moment forward. So the court adjusted the allowable discount of the $30 million receivable down to $28 million as opposed to $7 million. This is why in our Leverage G2 plan, the life insurance policy is designed to stay in force for the entirety of Generation 2's lifetime, not only to legitimately pay back the intergenerational loan, but also potentially generate an income stream for Generation 2, as well as a remaining death benefit for Generation 3, again, Generation 1's grandchildren. But a more recent case was the Levine case on February 28th, 2022. Now, in this case, the IRS attempted to get the policy cash surrender value included in the client's taxable estate. And in this case, the court ruled against the IRS in favor of Levine in every single code section violation accusation. According to our counsel, again, the former director of the Gift and Estate Tax Division of the IRS, the only area the IRS may attempt to dispute in our G2 plan is the amount of valuation discount. Now, in the Levine case, they use the economic benefit regime as opposed to the loan regime that we use, yet they were still awarded a 65% discount, which is pretty darn good. This case proved that generational planning, even when disputed by the IRS, still has great merit. So, in summary, if you want to reduce your estate tax liability without using any of your gift tax exemption, contact us and we will continue our discussions. And if appropriate, we can arrange a conversation with the law firm that we use in our Leverage G2 plan transactions. So we look forward to talking to you soon and look forward to saving you a substantial amount of estate taxes.